To me, what this is going to do is if I own a piece of property and I know that if I sell it, I'm going to be incurring a 66% capital gains, why would I ever bother selling?
This is the Saskatchewan Real Estate Podcast.
Hello and welcome back to the Saskatchewan Real Estate Podcast, your home for all things Saskatchewan, all things real estate. And holy man, did the federal Liberals in Canada cause a firestorm of conversation about changes coming in the federal budget to do with capital gains. And here to help me extrapolate on this news is Michael Hernick, the financial mechanic. Michael, you are a CPA, a chartered professional accountant, so you're the perfect person to kind of guide us through these new changes and help us understand what are the federal Liberals doing.
Yeah, absolutely, Ron. Thanks for having me. Just as a precaution, again, anything we discuss today shouldn't be construed as tax advice, but more is for educational purposes only. So, looking forward to sharing my insights on particularly some of the tax changes, and always consult your CPA.
Let's get right to those insights, Michael. What were your thoughts when the federal Liberals came down with that budget?
Yeah, so it's interesting because when you talk about budgets and taxation, is I like to kind of keep politics out of everything, but when you talk about certainly the tax impact, you're sort of forced to discuss the political side, but certainly, there's the 2024 federal budget has, different areas of spending for affordable housing. They've got different initiatives for AI and so forth. I think for anyone listening at home, I think you have to think about, two things. And the government isn't any different than a for-profit business in the such that you've got two moving lines. You've got revenues and expenses or inflows and outflows, right? So from a government spending perspective, that is your outflows. The question then becomes, well, if we're wanting to sort of balance that budget, we need enough inflows to pay for that spending. So the government, one main way they do that is through taxation. So certainly in this budget, we saw both, not just the spending side, but initiatives on sort of raising funds through different tax measures.
One could say, Michael, that for a long time, a lot of central bank spending could absorb a lot of this government spending. And I think now with the rise of inflation, what you're seeing is the rubber is hitting the road. That if you want to spend money, you also have to find a way of taxing the consumer base for this spending. And so for me, I take this as the first shoe to drop of this is maybe one of the first major tax changes that the government has made to say, here is the spending and here is how we are going to pay for it. And this is where usually people get really upset. And one of the main points of contention is the changes to capital gains. And can you just walk us through some of those major points there?
Yeah, for sure. So let's just take a high level overview of the federal budget. Again, I encourage everybody to read the federal budget and sort of, see what your perspectives are. So we have about $53 billion of spending, and a large portion of how that is going to sort of be offset with the revenue side is like you mentioned, is the capital gains change. So first of all, what is a capital gain? I think it's important for anyone at home to understand. So a capital gain, because it's a buzzword to a certain extent, but it is important that we know what that means is this simply the difference between what I sell capital property for and what my cost basis is. Okay. And this can only happen generally through a disposition. So you need to sell capital properties. So for most folks, this is going to be things like stocks. This will be real property. So things like land, building. This can also include, of course, things like depreciable properties. So, for business owners, you've got your equipment, furniture, fixture. So basically any sort of capital property, if you sell that capital property, you are going to have a capital gain. So what is the change and what's the big discussion about? So from 2000, the year 2000, the capital gain inclusion rate was 50%. So that means that half of the capital gain is included into income for tax purposes, both in the individual level and at the corporate level. This has not really changed since then, and this is why this is bringing up such conversation, is because now the federal Liberals have changed the inclusion rate from 50% to two-thirds, so effectively 66%. So an additional 16% inclusion rate. Okay. Now it's important to note that so how is this implementing, and how will this impact sort of the individual or business? So number one, this change doesn't come into effect until June 25th this year. So that gives taxpayers time to plan around these upcoming changes. Now, of course, for CPAs and really any individual, this is a very busy time of year because it's tax season. So it doesn't really allow professionals to really dig deep into the numbers and really think about this critically, because you do have to think about the short-term and the long-term impacts of, do I want to sell my capital property, like I said, stocks, real estate, equipment, and so forth, or do I not? And what happens if I do or if I don't? So for individuals, there is a bit of a cushion. So if you're an individual taxpayer, you have up to $250,000 where the rules will not change. So that means that for the first $250,000 of capital gains, you're still at 50%. So this is sort of the government's way of sort of sheltering, your ordinary taxpayer who may buy some, Apple stocks or whatever, any type of property, and say, well, as long as it's under, your capital gains are under 250,000, you're still at 50%. So anything above 250,000, again, this is for individuals, will be at 66%. So you kind of have that 250,000 cutoff. Now for businesses, so this is corporations and trusts, there is no $250,000 cap. So every single capital gain for corporations and trusts is going to be at the 66% or two-thirds inclusion rate. So that means basically all of your sort of small business owners, medium, large businesses, any disposition of capital nature is going to be at 66% inclusion rate into taxable income. So again, a lot of people may say, well, capital gains don't really happen that often. But when you think of, your small business owner, maybe you've got some equipment you need to sell and you want to upgrade. Well, there you go. You've got a disposition, right? Or you've got some, real property. So real estate, you've got some land you need to sell. You're going to have these capital gains. So that's important to note. There is some sort of measures to sort of alleviate some of this impact. So one thing that will change, I won't go into this too much, is that there's something called the capital gains exemption. So this is going from 1 million to 1.25 million. So they're kind of adding $250,000 to help sort of qualifying, small business corporation shares qualify for this. Again, consult your CPA. This is more for businesses that qualify if you want to sell your shares of your business. And then there's also some changes to, well, they implemented, I forget the name of it. I think it was the Canadian Entrepreneurship Incentive, where there's even a more of a cushion for entrepreneurs if they sell their shares, if they run particular businesses. So they're very, very sticky on which industries apply. They can get an additional $2 million. So to sort of kind of simplify things for the ordinary individual, again, anything above 250,000 will be at 66%, and for businesses, there's no cushion. Every capital gain will be at 66% inclusion rate.
Sticking specifically with real estate, Michael, and kind of people who would listen to this podcast, if they're thinking about the properties that are going to most affect them, to my understanding, a primary residence, there are no capital gains to be had as long as that property is the place that you are living. But if you own a residential real estate property, if there's a vacation, a cottage home, or if there are rental properties, these would all fall under this umbrella and kind of backstopping with some of those inclusions that you'd included to those limits and those amounts. Am I understanding that correctly?
Certainly for the most part, yes. Now, it is important to note that yes. So if an individual taxpayer owns the rental property themselves, these rules definitely kick in. So the first 250 is still at 50%. Anything above is at the 66% inclusion rate. You mentioned the principal residence exemption. So there's been some changes to this. It's important to note. So again, the principal residence exemption is sort of aimed for your primary residence, and in the act, as long as you've ordinarily inhabited that property, at some point during the year, you can claim that property as your principal residence. Now you have to be careful because it was just last year that the rules changed, where in the first year of ownership, you have to own the property for 12 months to claim the principal residence and this exemption. And this was to sort of target the the anti-flipping rules, so that you don't have sort of people buying property and flipping them. Now we can talk about whether that's good or bad, but these are the rules. But yeah, cottages can still be designated as principal residence as long as you met those rules for those specific years, because you can designate those years. But certainly, if they don't meet those rules, the principal resident exemption cannot be used. And for rental property, same thing. So
A lot of this stuff, and I'm not very well known to be an accounting side, but this to me sounds so backwards for what the government should be doing. At a time where you would like more property to be hitting the market, you would like more supply of homes for people to be getting into. To me, what this is going to do is, if I own a piece of property and I know that if I sell it, I'm going to be incurring a 66% capital gains, why would I ever bother selling? Why, I will rather just refinance that property, hold on to it forever, and never sell. So you are going to get this constriction of supply. At the same time, if you want businesses to get out there and build property, start businesses, why in the world would I invest in all of this new equipment if later on down the road I know that it's going to be really hard for me to offload? So for maybe a very temporary time, there might be this, they might get an injection of cash from the capital gains, but they're not going to get the projection they think they are, because people aren't stupid. They're not going to just willingly pay this tax. Am I viewing that incorrectly, Michael? Or what do you think about that prediction, that this is going to further exacerbate a slowdown in the economy, and it's going to limit supply, and the people who have stuff are just going to collect more stuff and never sell, and the people who don't have stuff are not going to be encouraged to join those who do?
it's a really insightful comment, Ron. I think that's exactly it. Anyone who owns, again, generally real estate or any kind of capital property, again, this is stocks, so will get included into this. We'll have to think twice on, do I even need to sell this? Because if I sell this, I'm going to incur the taxes. So when I think of a general view of what makes an economy, you need both buyers and sellers, right? And you need spending, you need people to spend money, but you need business owners to reinvest the money into their businesses and buy assets and so forth. That requires capital to move, right? And if you have a situation where now you've got individual or business taxpayers who are not moving, quote unquote, their assets because of rules like this, that will absolutely put a constraint on the flow of capital. So yes, I do agree that that is one of the negative consequences of doing this, is that you are going to have individuals, like you alluded to, either just refinance or just hold forever.
And you put it as a note of conversation, and I'd like to kind of touch on it now, that for people who have the means, the capital, the funds to invest and put it in places, they are not locked into investing in a certain market. And I wonder how this is going to affect Canada's competitiveness in the world. If you look at these high taxation rules and laws, do people start to look south of the border to say, and not to say that they're not also considering these same types of measures, because I do think that's been brought up but not yet implemented. Just talk about competitiveness, and whenever you add more restriction on individuals or businesses, how this might limit the amount of economic activity in the area.
Yeah, for sure. I think, again, when you look at GDP, a majority of GDP is investment into that said country. And that investment can be into any sort of, whether it's a business owner or whether it's, whatever the case may be, it's investment that returns on that investment, creating growth and economic growth. So when you think of it from a federal perspective, are we competitive to other markets? Well, if you take someone who wants to start a business and, like you said, isn't maybe necessarily geographically put in any respect, they will absolutely choose the area that will best facilitate their business operations and business transactions and so forth. It's interesting because when you look at some of the correspondence from the federal government, they're sort of saying, well, we're very competitive with the US with their tax rules. And I think they're sort of picking and choosing what those rules are. And when you look at it from a sort of holistic perspective, I don't think that's necessarily true. I can give you some examples of that. So in the US, we're talking about real estate. So they've got the 1031 exchange, which effectively, to a certain extent, incentivizes real estate owners to sell their property into further capital gains into like kind property. Well, again, we talked about capital flows. So when you have sellers selling their property and then you have buyers buying said property, again, you have movement of inventory. This is what you want at any general respect in the economy. In the US, generally speaking, homeowners are allowed to deduct their interest on their primary residence. You can't do that in Canada. Again, there's a lot of different depreciation incentives as well. Now we've tried to become more competitive with our depreciation regime, but there's the US has had accelerated depreciation for many years now, and we've just implemented that a few years ago in Canada. But some of those accelerated incentive depreciation rules are phasing out, and they actually start phasing out right away here. So, again, will it impact our competitiveness? Again, time will tell. But certainly, from a competitive landscape, I think will business owners and entrepreneurs be thinking about these changes? They absolutely will.
Not to get overly political, but I'd just like to catch your thoughts on this last question here too. That there is a sentiment now that, well, the people who have these assets are the most people able to cover these taxes, and to an extent that is true. But I think over time people miss out on the big picture, that at some point you or your children will fit nicely under that cap of what is included under that aspect. So you mentioned today that there's the $250,000 limit for an individual, but play this out over a 10-year period where we see maybe years of higher inflation, and all of a sudden people who were once not in this age group, they're all now being taxed for something that was marketed as a 1% tax. And just your last thoughts on that, Michael.
Yeah, absolutely. I think I think it's important to remember that when you look at the tax regime, really in any country, but in Canada, one of the core principles of the Tax Act, which sort of dictates our tax rules, is that it should be equitable and fair. And I mean, this makes sense, right? So the question then becomes, what is fair? So again, you can have different discussions on, is this fair? Is this not fair? Certainly, the impact to most individuals of this change will be that either they will not be impacted, or they may be later on, but not necessarily immediately. I think it's important to remember that that you know when you have entrepreneurs who invest capital, they're taking risk to create their businesses. You have investors who are buying real estate to turn them into rental properties, or have a business in developing these, or improving the property to sell it, whatever the case may be, right? All of these things do impact the economy, right? When you think of the business owner, when as their business grows, what happens? They hire employees, right? Real estate investors, what are they doing? They're providing housing for the community, particularly on the improvement and the flipping side, if you, as you call it. You're taking potentially distressed assets and turning them into something that's renovated, a really nice product. So at the end of the day, and we talked about this off air a little bit too. A lot of times, I think it's easy to just point the finger at, okay, well, the super wealthy should be paying all of these taxes. But I think it's also important to remember that who is the super wealthy and what are they doing, right? A lot of times we forget that a lot of the community initiatives that are happening because of wealthy individuals and corporations, right? I'm not to mention any names, but in your respective cities, you can look around, and any sort of building that has a sponsor name on it, chance 9 times out of 10 is because some type of business or individual did provide some type of incentive through some type of donation or whatever the case may be, to that initiative. Now, of course, is there tax incentives for doing that? Sure, there definitely are, particularly on the business side when it comes to donations. But the government could not do that on their own. So I think it is important. Again, it can be a sticky topic, but I think you have to look at both sides. It's easy to just say, well, let's just tax the 1% and good enough. But what are these large companies and wealthy individuals actually doing? And when you take a closer look, you do see that this capital does go back to the community in different ways.
As a mortgage broker, it's interesting news, and we talked about this off air too, that this is the greatest news ever. You're going to get people who forever hold properties and are going to forever hold loans on these properties. On a personal side, I really hate this. I really hate the fact that you're going to discourage people from getting into the market because of the lack of liquidity. And why invest this money? I might as well go do something else with it. And so these tools that people can use to elevate their financial situation are going to be limited. And the people who are already in the position of owning this property, you can just keep refinancing that thing forever, and you're never going to get taxed on that. And I think this leads to a dangerous place of, one way or another, we'll find a way to get the money out of you. And then you start to have, I think, really negative conversations around non-earned income being taxed. So we're not there at all yet, but I don't think this is going to do what the federal government think it's going to do. And I really appreciate you sharing your thoughts on this, Michael. And I think it's always really good to have someone who is, read up and providing insights. Just remind us again, Michael, if you did have a property and you were thinking of selling, remind us of that deadline again.
Yeah, so the deadline for the change to the inclusion rate, for all the changes is June 25th this year. So you basically have pretty much 2 months to figure out what you want to do with some of your properties. What I would say is, just as a cautionary point here, that this doesn't mean that you should be selling right away. Okay, you have to evaluate the pros and cons of selling. Does it make sense? What is the property doing for you? Is it, don't make short decisions without, having a real opportunity to sort of think through the consequences of doing so. But certainly these are things that you want to be thinking about.
Wonderful. Michael, you've been on the podcast before, so I'll ask it again because I do like hearing little bits of advice. But what advice would you give to a younger version of yourself?
Yeah, that's it. You always catch me at this. I wasn't ready for that. Honestly, I think the financial education piece, I think it's so important that that folks do take the time to sort of to read and listen to podcasts like yours, Ron, and really get familiarized with some of these things, because you may not necessarily see this on your conventional news media outlets or in the school system and so forth, where thinking through how all of this sort of impacts everything. So yeah, no, I think it just keep sort of learning as much as you can, I guess, early on. So
Wonderful. End us off, Michael. Where is the best place to catch the financial mechanic? I know you're on YouTube. Is there anywhere else where people can hear your insights?
yeah, for sure. So if you have any questions, thoughts, you want to reach out, I'm on LinkedIn. So just Michael Hernick, send me a connection. Be happy to chat there. And my email as well as Mike at thefinancialmechanic.com. So if you have any questions or would like to connect, look forward to chatting.
Thanks for checking out this episode of the Saskatchewan Real Estate Podcast. I hope you liked it and found value here. If you did, please consider hitting the like button and subscribing to never miss our future episodes. If you're in the mortgage market in Saskatchewan and you're doing a purchase, renewal, or refinance, I am a licensed mortgage broker and would be happy to help you with your next transaction. If you're interested, click on the link in the description of this episode. Until next week, I'm Ron Caroni, your Saskatchewan mortgage professional. Bye for now.